The screens are they're flashing red. I mean, everywhere you look in the studio right now, it is just this relentless sea of red.
Yeah, it's pretty staggering to watch in real time.
It really is. Today is February 28, 2026, and we are witnessing some truly unprecedented events unfolding across the global financial markets. Following the news of these coordinated military strikes by the U.S. and Israel on Iranian military and nuclear infrastructure, the immediate economic reaction has been, it's been explosive.
Explosive is definitely the word.
Right. We are talking about Bitcoin shedding $128 billion in market cap in a single hour. Gold is surging to just absolute record highs, and the Dow Jones Industrial Average just dropped 521 points in the blink of an eye. Honestly, it feels like total chaos. It feels like the bottom might just be falling out of the global economy. But is it?
That is the million-dollar question. Or I guess looking at the crypto markets today, maybe the $100 billion question.
Seriously.
When the headlines are this alarming and the tickers are moving this fast, it is incredibly easy to get swept up in the immediate panic. The instinct is always to just, liquidate everything and hide under the mattress. But as we've seen time and time again when reviewing a century of financial history, the initial market reflex doesn't always tell the whole story of the actual structural economic reality underneath.
Which is exactly why we brought the receipts today.
Yeah.
Welcome to this deep dive. For those of you listening who are just trying to make sense of your portfolios or, trying to understand how the localized conflict ripples across the entire globe, we have a massive stack of sources in front of us.
A very heavy stack.
Yeah, literally heavy. We aren't just looking at the daily news ticker here. We are pulling from comprehensive financial reports, heavy-hitting geopolitical risk assessments from major agencies like the U.S. Energy Information Administration, the commodity trackers at Gepler. We've also pulled historical market data stretching all the way back to 1927, alongside the real-time market tracking from right now, late February 2026. Our mission today is to cut through that noise. We want to extract the historical patterns of how markets actually react to war, uncover the hidden vulnerabilities in the global supply chain, and ultimately provide you, the listener, with a clear, data-driven framework for how to think about the economic fallout of this current U.S.-Israel-Iran conflict.
But before we really get into the weeds of these reports, there is a critical baseline we need to establish. The sources we're dissecting today detail highly complex, deeply politically charged military actions involving the United States, Israel, and Iran.
Very charged.
Right. And I want to make it absolutely clear to everyone listening that throughout this deep dive, we are maintaining strict neutrality. We are not here to take political sides. We are not endorsing any military actions. And we certainly aren't here to debate the geopolitical morality or the right and wrong of these specific events. Our lens is purely economic. Our goal is exclusively to analyze the financial, the supply chain, and the market impacts exactly as they are reported in our source material. We are simply letting the data, the historical precedents, and the physical supply chain realities map out the economic mechanics at play.
Okay, let's unpack this.
Yeah.
Because the immediate market reactions unfolding today are just staggering, and I want to start by looking at what the numbers are telling us right out of the gate. Late February 2026 is already cementing itself in the financial history books.
Without a doubt.
We have these major preemptive strikes from the U.S. and Israel on Iranian infrastructure and the immediate retaliation from Iran on U.S. Gulf bases and allied nations. The speed of the market's reaction was breathtaking. I'm looking at the real-time numbers from our Bloomberg terminal printouts right here. The Dow Jones dropped 521 points, and futures sank another 622 points in extended trade.
Just a massive gap down.
Yeah. The S&P 500 fell 0.43%, and the tech-heavy NASDAQ shed 0.92% right before the close.
The equities movement is significant, but if you look at the alternative assets and commodities in these reports, the story gets even more dramatic.
I was just going to say, the crypto reaction is wild. A lot of people have spent the last few years arguing that Bitcoin is a digital safe haven, digital gold, right? Immune to geopolitical shock. But today, Bitcoin plunged below 64,000. It wiped out 128 billion in a single hour.
Yep.
Meanwhile, physical gold, the traditional undisputed heavyweight champion of safe havens, skyrocketed to $5,296.50 per ounce. That caps off a massive 11% surge in February alone, which the reports note is the strongest monthly gain for gold since 2012.
What's fascinating here is the mechanics of how global markets instantly price in what analysts call geopolitical risk. When missiles fly, you immediately see the activation of the fear trade. Capital, fundamentally, is incredibly cowardly.
But cowardly. I like that.
It hates uncertainty more than anything else in the world. So the moment the news breaks, you see this massive, coordinated capital flight away from risk-on assets.
Let me stop you there for a second because I want to make sure we're defining our terms for everyone listening.
Yeah.
When we talk about risk-on assets and the NASDAQ taking a hit and Bitcoin acting the way it did, why didn't Bitcoin act like gold? Our sources mention it trading like a high-beta tech stock. Can you break down what that actually means in this specific context?
Yeah, absolutely. Think of beta as a measure of a stock's volatility compared to the overall market. If the broader market is a sturdy, reliable minivan driving down the highway, a high beta stock is a high-performance sports car.
Okay.
When the road is smooth and straight, the sports car goes much faster and outperforms the minivan. But the second you hit a massive pothole or a severe storm, like a sudden geopolitical conflict, the sports car is far more likely to spin out of control. Tech stocks, especially growth companies on the NASDAQ that rely on future earnings, are highly sensitive to economic shocks.
Right, because they need that stability to grow.
Exactly. And cryptocurrencies, despite their decentralized narrative, are heavily owned by the exact same institutional investors who own those high beta tech stocks. When those investors get a margin call or need to reduce their overall risk exposure immediately, they dump their most volatile assets first. That's why Bitcoin suffered that $128 billion wipeout. It traded like a risky tech stock, not a safe haven.
That makes a lot of sense.
Yeah.
So if the institutional money is fleeing the sports cars, where are they parking all that cash?
They run toward liquidity and guaranteed safety. As you noted, they run to physical gold, driving that incredible 11% monthly surge. But the real sponge for all this terrified capital is U.S. Treasuries. The sources note the 10-year Treasury yield is hovering right near 3.95% today.
And for anyone who gets tripped up by bond math, remember that bond prices and yields move in opposite directions. So when investors are panic buying U.S. government bonds for safety, the price of those bonds shoots up, which pushes the yield, the actual interest rate they pay out, down.
Precisely. The U.S. Treasury market is a $30 trillion ecosystem. It is the ultimate giant mattress to stuff your money under when the world feels dangerous. The U.S. government has never defaulted, so it's viewed as the risk-free rate. This initial shock we were seeing today is a classic textbook reallocation of capital based purely on fear.
But reading through these market assessments from Kompler and the EIA, the consensus seems to be, take a breath. Don't let the flashing red screens fool you into thinking the sky is permanently falling.
Right.
The sources suggest we shouldn't just look at this initial panic and assume it's the new baseline. They point to 3 specific signals that institutional investors are watching to determine if this shock is a temporary blip or the start of a deep structural market correction.
The first signal is the actual scope of Iran's retaliation. The reports highlight that because they targeted U.S. Gulf bases, the escalation could widen significantly before it stabilizes. The market is aggressively trying to price in whether this remains a localized exchange of fire contained within a few days, or if it broadens into a protracted regional war drawing in other nations.
And the third signal, skipping to the end of that list for a moment, is simply how equity futures respond in the coming days, particularly the Dow and NASDAQ futures. That will show us if the panic selling has exhausted itself, or if large funds are continuing to de-risk their portfolios as new information comes in.
Yeah, that's the short-term indicator.
But let's circle back to the second signal, because it is the big one. It's the one that has every commodity trader sweating right now. Potential disruptions to the Strait of Hormuz. Looking at the geopolitical risk assessments in our stack, the analysts are practically screaming about this waterway.
You really cannot understand the financial impact of a Middle Eastern war without understanding chokepoint economics. The Strait of Hormuz is the linchpin of the entire global economic reaction.
Let me paint a picture of this geographic bottleneck, because the physical reality of it is almost absurd when you consider its global importance. The Strait of Hormuz lies between Iran to the north and Oman to the south. It connects the Persian Gulf with the Arabian Sea and the broader Indian Ocean. When you hear strait, you might picture a vast, open body of water. But the actual shipping lanes, the deepwater channels where these massive, fully loaded supertankers have to travel, are incredibly narrow. We are talking about a navigable waterway that is just 2 miles wide in the inbound direction and 2 miles wide in the outbound direction, separated by a 2-mile buffer zone. 2 miles, you could practically see across it on a clear day.
It's tiny.
And yet, the volume of global energy that relies on those 2 miles of water is mind-bending.
The statistics from the U.S. Energy Information Administration really put it into perspective. We are looking at roughly 20 million barrels of oil passing through this strait every single day.
20 million barrels. That is 20% of total global petroleum consumption squeezing through a 2-mile gap every single day. And it's not just crude oil. The reports note that 20% of the world's liquefied natural gas, or LNG, also transits here. It is the absolute primary route for LNG from major producers like Qatar and the UAE to reach global markets.
But the vulnerability isn't just about a physical blockade. It's about the financial friction that a conflict creates in that specific area. Our sources detail the mechanics of maritime insurance in these scenarios, and it's a perfect example of how geopolitical tension translates directly into economic cost.
Right, let's look at those insurance numbers because they blew my mind. Normally, standard insurance rates for a modern tanker, let's say a vessel valued at $100 million, sit around 0.01% of the vessel's value. It's a negligible cost of doing business. But during high tensions, like what we are seeing this week in February 2026, the sources say that rate can jump to 1.0%.
Which fundamentally alters the economics of the voyage.
I did the math on that. A jump from 0.01% to 1.0% on a $100 million vessel means the shipping company is suddenly paying an extra $500,000 per week just for the privilege of passing through this strait. The financial pressure is immediate.
This is where we need to look at the concept of asymmetric warfare, which the reports indicate Iran has been heavily utilizing. The sources highlight something called smart control exercises conducted by the Iranian Revolutionary Guard Corps.
Wait, let me push back on that idea of asymmetric warfare here. If they aren't actually sinking ships or laying a continuous, impenetrable line of sea mines across the strait, why is the market reacting so violently? Surely global shipping companies and oil majors don't just stop doing business over a bluff or a military exercise.
It's not a bluff to the insurance actuaries. That's the brilliance and the danger of the strategy. Iran doesn't necessarily need to physically block the strait to cause severe economic chaos. They just need to prove that they can monitor, target, and autonomously detect vessels within those narrow 2-mile shipping lanes.
I see.
By conducting these smart control exercises and demonstrating their drone and missile capabilities, they maintain a state of constant, quantified uncertainty.
So the threat of violence becomes a financial weapon itself.
Exactly. They impose massive war risk premiums on global markets. It is a strategic transition from utilizing geography to weaponizing uncertainty. The insurance markets, the freight forwarders, the commodity traders, they all operate on risk models. They have to price in the worst-case scenario.
Which means paying that higher premium.
Right. So even if the strait remains physically open and ships are moving, the baseline cost of oil artificially inflates because of those insurance premiums you mentioned. It acts as a hidden tax on the entire global economy. It's a way for a nation to project power and inflict widespread economic friction without necessarily firing a single shot at a commercial vessel.
Here's where it gets really interesting, because when we hear Strait of Hormuz, our brains instantly go to oil and gas. That's what's on the news. But the data we pulled from Argus Analytics highlight a massive global ripple effect into completely non-energy commodities. This isn't just about keeping cars running. This is about agriculture.
A huge, huge part of this story.
The reports show that 50% of the world's seaborne sulfur trade and 32% of the global urea trade pass through this exact same 2-mile strait.
And we need to emphasize that those aren't just obscure industrial chemicals. Those are the fundamental, irreplaceable building blocks of global agriculture.
Right. Sulfur and urea are essential for producing phosphate and nitrogen fertilizers. The sources specifically point to major farming nations. Brazil and India are highlighted heavily that rely almost entirely on these Middle Eastern supplies to sustain their crop yields.
If we trace that supply chain, a disruption in the Strait of Hormuz isn't just an energy crisis, it rapidly mutates into a global food security crisis. When the cost of seaborne sulfur and urea skyrockets, either because of those war risk insurance premiums we discussed, or a physical slowdown of vessel traffic, the cost to produce fertilizer shoots up. Farmers, facing tighter margins, pass those increased costs down the line, leading to what economists call agflation, agricultural inflation.
So to make sure I'm connecting the dots here for you listening, a missile strike in the Persian Gulf, or even just the threat of one that spikes insurance rates, directly translates to a farmer in Brazil paying double for fertilizer, which means higher prices for a loaf of bread in Rio de Janeiro or a bowl of rice in New Delhi 3 months later.
That is the exact mechanism. The hyper-interconnectedness of these modern supply chains means the Strait of Hormuz acts as a critical, fragile node for the basic cost of living worldwide. It's not just the price at the pump, it's the price at the grocery store.
Which perfectly transitions us to the data on who is actually taking on the most risk here. Because while agflation is a global problem that hits everyone's wallet, the direct energy risk of the Strait of Hormuz is highly, highly concentrated. The EIA estimates in our stack show that 84% of the crude oil and 83% of the LNG shipped through the Strait in 2024 went straight to Asian markets. Just 4 countries, China, India, Japan, and South Korea, account for 75% of the oil, and 59% of the LNG flows through this choke point. That is a staggering lack of diversification.
The analysts at Zero Carbon Analytics actually developed a fascinating metric to quantify this specific vulnerability. They call it the risk score, and the formula they use is quite elegant in its simplicity, but terrifying in its implications.
Walk us through how they calculate that.
The risk score is calculated by multiplying 3 distinct factors. First, the nation's share of petroleum and liquid fuels coming specifically through the Strait of Hormuz. Second, they multiply that by the nation's overall reliance on imported energy, meaning how much of their power grid relies on stuff they have to buy from other countries. And third, they multiply that by the share of oil and gas within their total fossil fuel imports.
Okay, so when you run the numbers on that formula, the country breakdown in this report is eye-opening. Let's look at Japan first. Japan has a risk score of 6.4, making it the single most vulnerable nation on the list.
By far.
The sources state that a total blockade of the Strait could surge their LNG prices by an unbelievable 170%. And we aren't just guessing about the fallout. We've seen previews of this before. The reports note that in past energy price spikes, the Japanese government had to roll out a 25 trillion yen package, that's roughly $170 billion, just to subsidize utilities, compensate users, and prevent average household electricity bills from completely crushing the consumer class. It's an existential economic threat for them.
It really is.
Then you have South Korea right behind them with a risk score of 5.3, largely because they get a staggering 81% of their total energy from fossil fuel imports, almost all of which comes on boats.
But if you dig into the geopolitical risk assessments, the truly complex case study here is India, which comes in with a risk score of 4.9.
Yes, I want to spend some time looking deeply at India's position because the nuances here are incredible. According to the data, 50% of India's total crude oil imports, which amounts to roughly 2.5 to 2.7 million barrels per day, transits the Strait of Hormuz. These barrels are largely sourced from Iraq, Saudi Arabia, the UAE, and Kuwait. But it's the timing of this February 2026 conflict that makes India's situation so uniquely precarious.
Timing is absolutely everything in commodity markets, and India's recent strategic moves have placed them in a very delicate position.
Right, because over the past few years, Indian refiners executed a massive strategic pivot. Following the geopolitical fallout and sanctions surrounding the Ukraine conflict, India became a massive buyer of heavily discounted Russian crude. They were scooping up Urals crude at a bargain.
Yep, completely reshaped their supply lines.
But recently, just in the last few months leading up to this 2026 war, due to tighter Western sanctions on Russian oil firms like Lukoil and Rosneft and payment settlement issues, India pivoted away from Russian crude and started shifting back toward Middle Eastern baseload barrels. They essentially retethered themselves to the Persian Gulf. So they accidentally increased their short-term vulnerability to the Hormuz choke point right at the exact moment the region exploded into conflict.
It's a classic geopolitical catch-22. They shifted their supply chain to comply with one set of global pressures, only to walk right into a massive physical bottleneck. However, the Kupler tracking data points out a very critical fail-safe for India that prevents this from becoming an immediate catastrophic supply shock on day one. While their reliance on Middle Eastern crude has ticked back up recently, there is still a massive amount of what the industry calls oil on water.
I love that term, oil on water. It sounds poetic, but it's a hard logistical metric. Explain how that saves them.
It means there are massive fleets of oil tankers, specifically Russian cargoes, currently floating in transit across the Indian Ocean and the Arabian Sea, as well as significant volumes held in floating storage vessels just sitting off the coast. If the Strait of Hormuz were to be completely shut down by military action today, India isn't instantly out of oil tomorrow. They can rapidly pivot back on the spot market to purchasing that Russian crude that is already physically close to their
It's
ports.
basically the equivalent of keeping a frozen pizza in the back of your freezer. You might prefer to order fresh takeout from the Middle East, but if the delivery guy gets stuck behind a massive geopolitical roadblock, you aren't going to starve tonight. You just heat up the Russian pizza.
That is a surprisingly apt analogy. That floating inventory provides vital near-term supply elasticity. It gives the Indian economy a commercial buffer that a country like Japan, which relies on specialized LNG carriers that operate on very rigid long-term contracts, simply doesn't have. So while India's overall risk score is high at 4.9, their logistical flexibility and access to that oil on water might just save them from the worst of an immediate, paralyzing supply shock.
Which brings us to a massive question for you, the listener, who might be staring at your 401k or brokerage account right now, wondering what to do. The headlines are screaming about World War III. The Dow is down 500 points. Does war actually destroy the stock market? To answer this, we need to look at the historical data in our stack stretching all the way back to 1927. And when you look at the raw, unfeeling math of it, the historical record of how equities behave during global conflict is incredibly counterintuitive.
It really is. I think most retail investors instinctively assume that war equals a prolonged market crash. But the data from the last 100 years tells a much more nuanced story of capital resilience. To understand how markets might process the events of February 2026, we have to look at the stark differences between how markets reacted in the 1970s versus the 1990s.
Let's dive into those two eras because they paint very different pictures. The 1970s were absolutely brutal for markets. You had the 1973 Yom Kippur War, which triggered an Arab oil embargo that saw oil prices jump 300% from roughly $3 a barrel to $12 a barrel. Then, just a few years later, you had the 1979 Iranian Revolution, which saw oil jump another 160% from $13 to $34. The reports note that this created a toxic economic environment of prolonged stagflation.
Right. Stagflation being that devastating combination of high inflation, high unemployment, and stagnant economic growth. When the fundamental input cost of the entire global economy, oil, triples overnight, corporate profit margins are obliterated. Equities were severely depressed for a decade during that period.
It was a lost decade.
Exactly. But then, look at the data from the 1990 Gulf War. When Iraq invaded Kuwait, the S&P 500 initially dropped between 10% and 17% as panic set in. But over the following year, the market didn't just recover. It rebounded roughly 20%.
So what changed? Why did a war in the Middle East in the 70s cause a lost decade for stocks? But a war in the Middle East in the 90s caused a brief dip followed by a massive rally.
What we are seeing there is a structural evolution in how markets price risk, combined with changes in the global energy supply. Across major conflicts, World War II, Korea, Vietnam, the Gulf War, the 2003 Iraq War, Afghanistan, there's a distinct repeating behavioral pattern among investors. It starts with what analysts call pre-war jitters.
The jitters.
Yeah. In the lead up to a conflict, when troops are massing on borders or rhetoric is escalating, the uncertainty is at its absolute maximum. Markets hate the unknown more than they hate bad news. So asset prices depress before the first shots are even fired.
Our sources mentioned the commodities futures markets going into backwardation during this pre-war jitter phase. Can you give us an ELI 5 on backwardation?
Yeah, imagine a massive hurricane is forecasted to hit your city in 3 days. The price of a portable generator at the local hardware store is going to skyrocket right now, today, because you desperately need it immediately.
Right.
But the price to order a generator for delivery 6 months from now, that price stays relatively normal because the storm will be over. That's backwardation. There's a huge premium placed on possessing physical commodities immediately because no one knows what tomorrow brings or if supply chains will exist next week. The near-term price is vastly higher than the future price.
Okay, so the tension builds, the market sells off, commodities go into backwardation, but then the shooting actually starts. The war officially begins.
Exactly. And once active hostilities commence, a very strange, counterintuitive thing happens to the financial markets. The uncertainty resolves.
Even if the news is terrible.
Even if the news is terrible. Because it is now a known terrible, the market can finally quantify the risk. The analysts can calculate the burn rates, the supply disruptions, and the geopolitical boundaries of the conflict. The war premium that was artificially inflating prices collapses, and historically, equity markets recover rapidly from that point.
The historical data in our sources gives a perfect example of this from the 2003 Iraq War. In the tense build-up to the invasion, The market was bleeding. At the actual start of the war, the S&P 500 dropped 5.3%. But once the parameters of the conflict were established, over the next 12 months, the S&P 500 rallied 26.7%. Even during the horrific, unprecedented events of 9/11 and 2001, the market fell sharply by over 11% when trading finally resumed, but it recovered its prior levels within 15 trading days.
Modern markets have become incredibly efficient interpreters of military outcomes. They price in the worst-case scenario early. As long as there isn't permanent catastrophic damage to global production infrastructure, like the structural supply shocks of the 1970s oil embargoes, the underlying supply and demand balance of the global economy reasserts itself. Corporate America keeps making products, consumers keep buying them. The stock market's structural resilience usually shines through the geopolitical noise.
So if we are trying to extract a lesson for anyone managing investments today in 2026, the extrapolation here is crucial. The historical data strongly suggests that history favors those who hold. Knee-jerk liquidations, panic selling your index funds or equities the moment a war breaks out and the screens go red, have historically proven to be incredibly expensive errors. To use the data from our stack, if you panicked and sold at the bottom of the Korean War dip, you locked in your losses and completely missed a 20% return the very next year.
That is the dominant historical trend for equities. But we must add a significant caveat here. While broad equity indexes tend to recover over the long term, physical commodities behave very differently during the immediate timeline of a conflict. And that divergence is exactly what we're seeing today.
That is a great pivot, because while the Dow and NASDAQ are dropping right now in late February 2026, commodities are absolutely surging. They're acting as the true safe havens and the real-time thermometers of geopolitical fear. Let's look at the specific commodity surges detailed in our reports. Let's start with the big one. Oil. Currently, Brent crude is hovering around $73 a barrel. That's up from about $67 before the strikes. But the forecasts in these analyst notes are wild. JP Morgan has put out a note predicting oil could hit $130 a barrel if the Strait of Hormuz closes entirely. That would match the devastating all-time high of the 2008 oil shock.
Yeah.
And then you have political figures like the Iraqi deputy prime minister warning it could hit $200 to $300 a barrel.
We have to separate the rhetoric from the math. Those higher numbers, 200, 300 a barrel, coming from political figures are often rhetorical tools. They are designed to pressure the international community into intervening. But the JP Morgan estimate of $130 a barrel, that is a hard mathematical assessment of what happens to global inventory levels when you suddenly remove 20 million barrels a day from a finely tuned global supply chain.
And oil isn't the only commodity going parabolic. We always talk about gold during a crisis, but the sources highlight silver as a massive, often overlooked story here. Silver has incredible war cycles.
It does, and the reason is twofold. Silver benefits from the same monetary safe haven status as gold, but unlike gold, it has massive critical industrial applications.
Right, it's used heavily in munitions, advanced electronics, solar panels, and guidance systems, all of which see huge immediate demand spikes during wartime as governments ramp up defense production. The sources highlight a jaw-dropping statistic on this. Silver surged 320% from its 2025 baseline levels, hitting an all-time high of $121 per ounce in February 2026. A 320% gain in a physical metal is just astonishing.
It is, but if we connect this to the bigger picture, we have to look at what I call the Hormuz threshold for oil. This is, without a doubt, the most critical metric for every investor to watch right now. It dictates everything else.
Explain the Hormuz threshold. What is the magic number?
According to the macroeconomic models in our sources, as long as oil stays below $80 a barrel, global markets view the conflict as contained and financially manageable. The global economy, given current growth rates, can absorb $75 or $79 oil without stalling out. Transportation costs remain viable, and inflation remains relatively steady.
But what happens if it crosses that $80 threshold? Say JP Morgan is right, and it starts marching toward $130.
If it breaches 80 and sustains a move toward $100 or $120 a barrel, the math changes entirely for the global economy. That level trips what analysts call economic recession triggers globally. Oil is the master commodity. It dictates the cost of manufacturing, shipping, and travel. A sustained spike causes massive, sticky inflation. And here's the crucial connection back to the stock market. When inflation spikes aggressively, central banks like the Federal Reserve cannot lower interest rates to stimulate the economy. In fact, they might have to raise them.
And higher interest rates are kryptonite for the stock market, particularly the NASDAQ.
Precisely. This heavily impacts tech-heavy indexes. Growth stocks are valued based on models of their future earnings. When inflation is high and interest rates rise, the present value of those future earnings plummets. So to bring it all together, the price of a physical barrel of oil transiting the Persian Gulf directly dictates the valuation of a software company headquartered in Silicon Valley. If oil breaches $80, the NASDAQ faces serious structural headwinds.
That is an incredible, terrifying connection. The global economy really is just a tightly wound spring. Now, while tech stocks might suffer under a high inflation, high oil scenario, looking at our reports, there is one sector of the equity market that plays by a completely different set of rules during a conflict. Let's talk about the defense sector. Now, I think it's obvious to anyone with a pulse that defense stocks companies like Lockheed Martin, RTX, Northrop Grumman go up when war breaks out.
It's the most intuitive trade in the market. Missiles are fired on the news, so the companies that manufacture missiles make more money. It's a very simple mental model.
Right. But the financial reports we are looking at reveal that the reason these stocks are so incredibly valuable to institutional investors has fundamentally changed over the last decade. It's no longer just about selling a single fighter jet or a single batch of missiles.
This is a crucial insight that most retail investors miss. The modern defense industry has completely transformed. It is no longer a traditional cyclical manufacturing business where you build a widget, sell a widget, and look for a new customer. It has become a recurring revenue ecosystem. The Government Accountability Office report in our the GAO report, notes a staggering statistic about this. 70% of a major weapons system's lifetime cost is tied up in operations and support.
Hold on, 70%. So when the Pentagon or a foreign government buys a new advanced fighter jet, the multi-million-dollar sticker price of that jet is only 30% of the money the defense contractor will eventually extract from the government.
Exactly. When a government buys an F-35 fighter or a Patriot missile defense system, they aren't just making a one-off hardware purchase. They are locking themselves into decades of proprietary maintenance contracts, constant software upgrades, specialized spare parts, and mandatory system integration. It is, for all intents and purposes, a subscription model.
It's like buying a high-end printer, but you are legally obligated to buy their hyper-expensive ink for the next 40 years. It's a subscription to national security. And you can clearly see the results of this model in the financial data. The sources list the current locked-in backlogs of these defense giants, and the numbers are astronomical. Lockheed Martin currently has a $194 billion backlog. RTX, which was formerly Raytheon, has a $268 billion backlog. Northrop Grumman has $95.7 billion. When you buy a defense stock today in 2026, you aren't just buying the immediate news cycle of the U.S.-Israel-Iran strikes. You're buying into decades of guaranteed government-funded maintenance and software contracts that are already legally binding.
Which provides a level of earnings visibility that is increasingly rare in the broader market. You don't have to guess if Lockheed Martin is going to have revenue in 2035. It's already on the books. The institutional reports note that large asset managers realize this, and they are viewing the defense sector as being in the midst of a generational portfolio reset. We are moving away from the asymmetrical war on terror era, which was relatively cheap, utilizing counterinsurgency tactics, into a new era of great power competition. This new era is heavily focused on AI, autonomous drones, and space-based defense systems. These are highly complex, incredibly expensive systems to maintain.
And as you mentioned earlier, wars eventually end, treaties get signed, the shooting stops. But the maintenance contracts do not end. The software still needs its annual update. The drone fleets still need servicing.
Exactly. This makes the defense sector a core structural hedge for long-term investors. It's no longer just a cynical, cyclical trade you hold for a few months during a crisis. It's a foundational piece of a portfolio designed to weather geopolitical instability.
So, after digging through all of this, we've covered the immediate market shock, the intense choke point economics of the 2-mile-wide Strait of Hormuz, the specific vulnerabilities of the Asian market and India's oil-on-water failsafe, a century of historical market data proving the cost of panic selling, the commodity spikes in oil and silver, and this new, incredibly lucrative subscription model of defense stocks. Let's synthesize all of this into a concrete strategy. Based on our massive stack of sources, if you are a listener trying to navigate the financial realities of this 2026 U.S.-Israel-Iran war, here are the core takeaways. First, don't panic sell. The historical data from the last 100 years proves the stock market's immense structural resilience. Short-term drops, like the 500-point Dow drop we saw today, are completely normal. They are the pre-war jitters and the cowardice of the fear trade at work. The long-term growth and recovery, once the uncertainty resolves, is the historical standard.
Second, watch the oil price. Specifically, keep a very close eye on that $80 per barrel threshold. That is your macroeconomic canary in the coal mine. If Brent crude sustains a move past 80 and heads toward 120 due to prolonged disruption, that signals broader systemic inflation. And that inflation will likely trigger a larger, more painful correction in tech stocks and consumer discretionary sectors as interest rates remain elevated.
Third, look at diversifying with defense and safe havens. Recognize the recurring revenue power of the defense sector's massive, multi-hundred-billion-dollar backlogs, and respect the traditional liquidity safety of U.S. Treasuries and precious metals like gold and silver, which have proven their worth by surging this month.
And fourth, something that ties the geopolitical to the environmental. The energy transition is national security. The extreme vulnerability of Asian nations, particularly Japan's risk of a 170% LNG price surge and India's reliance on the Strait of Hormuz, proves a vital point. Transitioning to renewable energy, investing in domestic nuclear, and electrifying economies isn't just an environmental initiative or an ESG goal anymore. It is an urgent, fundamental national security requirement. It is the only way for these nations to permanently escape the trap of chokepoint economics.
It really reframes the whole green energy debate. It's not just about carbon emissions. It's the only way to ensure that a localized geopolitical conflict 2 oceans away doesn't physically shut off the power grid in Tokyo or starve the agricultural sector in Brazil. It is all deeply, intimately connected.
It is entirely connected. But before we wrap up, diving through all these reports raises one final, rather provocative question. We've spent an hour discussing physical choke points, maritime shipping lanes, and physical barrels of oil moving on steel ships. The traditional historical playbook we analyzed says that markets eventually recover when physical uncertainty ends and supply chains adapt. But what happens when the battlefield moves entirely into the digital realm?
What do you mean by that?
Embedded in one of our geopolitical sources was a terrifying, almost throwaway detail about the February 2026 strikes. Iran's internet connectivity dropped by 46% due to coordinated cyber operations. Nearly half the country went dark digitally in an instant. This was a connectivity war happening simultaneously with the physical kinetic strikes. So if we look to the future, if the next major global choke point isn't a physical strait measuring 2 miles wide, but rather the global digital infrastructure itself, the undersea fiber optic cables, the massive cloud server farms that power the very financial markets we rely on, are traditional safe havens truly safe anymore? If you physically cannot access your digital brokerage account, or if the blockchain ledger of ownership is compromised by a state-sponsored cyber attack, does it actually matter that your portfolio was properly diversified with gold ETFs and defense stocks?
Wow. Okay, that is a genuinely unsettling thought to leave on. The idea that the very digital architecture of the market could be the next Strait of Hormuz. That is absolutely something we are going to have to explore in a future deep dive. For now, thank you to everyone for joining us as we unpack the staggering, chaotic events of February 2026. Keep your eyes on the data, remember the historical precedents before you make a move, and as always, keep questioning the headlines. We'll see you next time.